All right, so today, as I said, we're going to do two things. One, we're going to go over the super tree homework assignment, and two, we're going to go over the group projects. So let's start out with the super tree. For Walgreens, CVS, and Rite Aid. So as part of the super tree, you're filling out the end of year ROIC for the companies, and one of the first challenges that you would have uncovered was a problem with the fiscal year ends. Because CVS apparently has this weird fiscal year that ends in August, where everybody else doesn't. So you kind of have a misalignment of the time sequences by about 4 months. So because it's only about 1 quarter off, I think it's a fair comparison to align up all the numbers, but nonetheless, it would affect our analysis slightly. But for our simplistic analysis, putting everything together is fine. So whether you called this final year 2013 or 2014 doesn't really matter, as if you put all the last 5 years, because fiscal 2014 for Walgreens and Rite Aid is 2013 data. And 2013 for CVS is really 8 months worth of 2013 anyway. So I think that is fine for our purposes to just line them up. And I'm going to be less concerned about what the year is, as long as you knew they were the last 5 years. Yes?
What if you left 2014 for CVS blank on this sheet?
Well,
use the future projections on that.
The only challenge with doing it that way is if you only did 4 years of CVS, you're really getting 8 months of 2013, because this is really 2013, and what you're really doing is you're leaving 2013 off of CVS.
Because what I did, I just for the sake of the end of the year averages, I still use the 2013.
But 2013 for Walgreens and Rite Aid is really 2012.
Well, I'm saying I use the 2013 for CVS and then use the 2014 for Walgreens and Rite Aid for the averages.
But what I'm saying is that the 2014 for Walgreens and Rite Aid is really 2013 data.
Okay.
Just because they only have 1 month of fiscal year going into 2014. So it would have been better to just line up the historical years. But in any event, that shouldn't happen with your construction industry companies for this particular section, and shouldn't really happen in the other sections as well. But here's the real point of the super tree analysis. So when we do the ROIC trees, obviously we're getting insight into what's happening with our company, but I think it's also important to understand a little bit more depth of what's happening at an industry level, particularly when we're doing the I of the IC. So here's an example of this. Now, in an ideal world, this is a straight average, and I should do a weighted average based on market cap. But for simplicity of this assignment, I just had to do a straight average. But here's the idea. We can see that this industry of retail pharmacy is improving its performance from 7.6% average ROIC to about 13.5%. Okay, so we can see improvement. However, the devil's in the details, and we can see that almost all the industry performance is a result of Rite Aid going from about a 1% ROIC to about an 18% ROIC. So it's really not that the industry is getting better, because Walgreens and CVS have had pretty consistent performance for the last 5 years. CVS getting a little bit better, but this isn't really a dramatic improvement of the industry. This is really Rite Aid catching up with Walgreens and CVS. That's making the industry look more attractive. But I think it's more of a laggard catching up by improving its performance than really an industry that's getting substantially better. And by doing the tree analysis, that starts to become more of a clear picture. And this is going to be important when we start thinking about the attractiveness of the industry in the past and in the future, that really I don't think that this is getting to be that much more of an attractive industry. As a matter of fact, for Walgreens, their position's kind of worsening over the 5 years. And it's really, as I said, Rite Aid is behind the overall level of improvement. All right, so that's what we see. However, back to the point. The industry is getting better, mainly because of Rite Aid's improvement. Walgreens getting a little bit worse. Now, if we look at the tax rates, we can clearly see that the industry is paying a little bit more in tax, and that's because Rite Aid went from losing money to making some money and therefore paying some taxes, Cash tax rate went actually up for CVS and Walgreens, but here's the point. The reason the ROIC went up is not because of taxes, it was all pre-tax ROIC. So again, the pre-tax went from 12 to 18. Again, most of that was driven by Rite Aid. In terms of the margins and the productivity, the primary reason I think that the ROIC went up, we'll start with the margins. The operating margins went from about 3.9 to 4.6. There's a pretty good improvement in operating margins, right? But again, kind of misleading because almost all that improvement in operating margins came from Rite Aid going from breaking even to making almost 3% margins. So really the improvement was again driven by Rite Aid's catching up with the profitability of their peers as opposed to their peers making more money. Because to some degree, the two peers, CVS and Walgreens, actually made less money during that 5-year period of time. So again, it's kind of a little, at an industry level, misleading to say the profitability is getting better because, as I said, I think it has more to do with Walgreens and CVS being relatively steady and Rite Aid improving as opposed to the industry overall improving as a trend. And the one area, though, that we are seeing overall improvement is in productivity. All three of the firms, change the formatting on that, all three of the firms had improvement in their productivity. So what that meant is for Walgreens, basically as their margins fell, they made up for it with improved productivity. At CVS, as their margins fell, they also made up for it with improved productivity. Rite Aid got better margins and better productivity, which is why their ROIC had the most dramatic increase. And that's what we see at the first level of analysis. For the second part of the tree, what we can then see is on the income statement level that really it was, from a gross margin standpoint, not really a big change in the gross margin in the industry. Walgreens was flat, right around 30%. CVS went down about 2%. Rite Aid went up about 2%. So Rite Aid and CVS kind of cancel each other out at the industry gross margin level. So really the savings in this industry that led to the operating margin improvements happened at the SG&A level. So it was the SG&A savings at CVS and Rite Aid that really drove the industry profitability along with Rite Aid's gross margin. But at the industry level, it was the SG&A. Depreciation really didn't change. Productivity. Productivity was across the board. All companies saw less working capital. All companies saw better store efficiency, which is PP&E to sales, and that improved the overall productivity of the business, right? So really the story is lower SG&A, better utilization of working capital and PP&E at an industry level. And the real story here is that it's not really a better industry. It's just Rite Aid is kind of what I would say regressing to an average level of performance by improving their subpar performance rather than the industry getting a lot better. Right? So it just so happened that that's the way this industry played out, but that's just kind of an additional nuance for a level of detail we wouldn't have seen if we had just done the pure RV analysis. Right? The other half of the super tree would have been the cash flow. Now, again, while I was in the hospital and under heavy sedation, I did not finish the cash flow part of the tree. So what I did earlier today, so I'll post the final solution later, but I randomly downloaded one of the student submissions. So I'm assuming it's mostly right, but I can't say with 100% certainty because I've gotten mixed messages in the previous sections. But in any event, let's assume it's either right or close to being right. But as I said, at least as a proxy for our conversation. The point of the CFI is, in the real world, this is what the senior execs that I've actually dealt with care a lot about, right? And when I show them a slide that looks like this, we actually spend a lot of time talking about this. And I think when you have your corporate version of your presentation for your companies, this is what's going to be very interesting. Because a lot of companies will track what their payout is and what their reinvestment is, but they don't really track it at an industry level and look at what they're doing with all of their peers. And that's what we're kind of doing here. So like with the super tree, for the ROIC, we're tracking at industry level. We're now doing the same thing with the CFI. And there's really 4 major sections that I think people care about, and that's what are on here. So how much cash is the industry generating? Cash profit. That's the gross cash flow. So for Walgreens, CVS, and Rite Aid, that's about $60 billion over the last 5 years. Second, how much free cash flow are they generating after investment? And again, for these companies, about $40 billion, which means about $20 billion was reinvested back into the business. Now, from a reinvestment rate standpoint, gross investment divided by gross cash flow, about 27% of the gross cash flow was reinvested back into the business. That's our reinvestment rate, okay, in this business, right? So essentially that means we have about 70, call it 73% to pay out. Well, if we look at that, we paid out of the $40 billion of free cash flow, about $30 billion, $29 billion and change was paid out to the shareholders in terms of dividends and share buybacks. So I think that's really the interesting data. And to me, the other point is to get a sense of the reinvestment rate. And I want to focus on Rite Aid. Notice that Rite Aid's reinvestment rate is about 1/3 of the reinvestment rate of CVS and Walgreens. And then let's go back to the previous slide and talk about Rite Aid's performance. Let me go back to my tree. Rite Aid's performance was really improved over the last 5 years. One could surmise that part of the way that Rite Aid has been improving their performance is because previously they stopped investing. So that's the point. I'm lagging my peers, so one way to catch up with my peers is not to spend any money. So where my peers are spending money opening up new stores, I don't open up new stores. When my peers are spending money on marketing and advertising, I don't spend money on marketing and advertising. I basically cut my expenses. In the short run, that probably improves my performance. But here's the thing. If I'm really valuing Rite Aid and I see that they're investing 10% and their peers are investing 30%, they're probably underinvesting, which means in the short run it's making them look better, but in the long run there could be some competitive challenges. So where CVS and Walgreens are opening up new stores, changing their formats, the kind of cooler places to shop, I don't see that about Rite Aid. In fact, the last couple of Rite Aids I've been into, I don't really want to go back, right? They're kind of shabby looking stores. The merchandise is not in very good shape. It just does not look like a well-run store. And to me, I think that is somewhat indicative of that low level of investment. And so at some point, I don't think they're going to be able to underinvest compared to their peers to continually to improve their performance. So again, that's part of the other tie-in between these two statements that I would like to ascertain. I'd like to test that out and get into more detail, but I'm just saying this is an old trick that people would make in finance, which is starve the business of capital and force it to improve. And that's really what I think Rite Aid has done, which is they've kind of starved the business, not really invested, and they've cut a bunch of costs, and that made the financials look better, but I don't think fundamentally they're going to be able to sustain that on a go-forward basis. It did make them financially more attractive, but as I said, I think that was a short-term fix. I don't think that was a long-term fix. So that reinvestment rate is probably low on a go-forward basis. So even when I look at their ROICs, I don't see this ROIC, which is now the best in the industry, as something that's sustainable. Because when they start having to reinvest at the same rate that a Walgreens or CVS start to invest in, their ROIC is going to fall. So if I were doing competitive analysis, I would want to put that into my conversation. Does that make sense? Questions about that? More than I would have expected you to do in your ROIC tree, but it does set up some of the analysis that I'm going to want you to do in your presentations and group projects. So what I really want to do is spend the rest of our time talking about that, presentations and group projects, specifically what's required of you on Monday, right? So on Monday, what we're going to do is at 10 a.m. for all sections, you have to turn in 3 files. Now you're going to turn it in as a group. So I don't need everybody to do it, but I need at least one of your team members to do it on behalf of your group. So there'll be a link on Canvas, and you're going to submit 3 files electronically. One, you're going to do a PowerPoint file, and that's going to be the PowerPoint file you're going to deliver Monday afternoon. So Monday afternoon, you're going to do a 10-minute PowerPoint presentation. Okay, so you're going to have to give me that 10-minute PowerPoint file with all the exhibits that morning. And it's going to be very important that that file contain everything in it, because you're not going to be allowed to go beyond that PowerPoint to show me anything else. So you can't just pull up the Excel file and say, oh, by the way, here's some additional data. If you want to show data that's in the Excel file, you got to copy and paste it and put it in the PowerPoint. Part of the reason why I'm going to require this is that there's an inherent unfairness at presenting first. The team that presents first on Monday is at a severe disadvantage. And the reason why is the teams that present later can see what the team that did first did right and wrong. And they will inherently then adjust their presentations accordingly. Because you can say, oh, gee, there was a really good section and we forgot to put that section in, so I'll put that section in by jumping outside my PowerPoint and showing this extra data. So that's why I'm not going to let you do that, right? Because it's really unfair to the teams that went earlier. So you can only present what is in your PowerPoint file. So everything has to be self-contained, and it has to be submitted by 10 a.m. Okay, so that way you can't really rely on what's done at previous groups as well. So that is what you're going to have to present. Second, I'm going to hold you all to 10 minutes. So I'm going to have a countdown timer on my iPhone. When it hits 0, you're done. I'm going to stop you in mid-sentence. I'm not going to give you, oh, I need 30 more seconds. No, you're done. Again, fairness to all the groups. So what that means is you have to cover all 4 sections in those 10 minutes. So if you get through 2 of the sections in 10 minutes and you get to not 2 of the sections in those 10 minutes, then you lose half your grade. Okay? So even if it's in the PowerPoint file and you don't get to it, I'm not going to grade it. So you have to manage your time very efficiently. You got 10 minutes to cover 4 sections. So be very careful about how you do that. Second file you're going to have to turn in is your final Excel valuation. I don't need your as is, but I do want your final. So you turn in that Excel file. The third file that you're going to submit is your write-up. Again, it should have everybody's name on it, your team, but basically that's that 12-page paper plus exhibits. And again, the paper is graded independently than the PowerPoint. So all the exhibits need to be in the paper, all the exhibits need to be in the PowerPoint. If they're in the PowerPoint and you don't have them in the paper, you're going to lose points in the paper. If they're in the paper and they're not in the PowerPoint, you're going to lose points in the PowerPoint presentation. The exhibits have to be in both, right? So they're going to be graded independent of each other, right? Questions about any of that? Right? So for Monday, I'm not going to have a dress code. Now, when the corporate presenters are here, there will be a dress code. For Monday, I'm less worried about the dress code. But I will say that you have to also decide on who's presenting for your teams, right? And your team is going to be responsible for covering all the material in the 10 minutes. So you can use one person. One of the teams earlier said, can we have 4 people? You can use as many people as you want. But I'm also telling you, if you use 4 people and one person takes 6 minutes, I'm not giving the rest of the team more time because one person went over. Then you got 4 minutes for the rest of the team to cover the rest of the materials. So make sure, especially if you break it up into multiple sections, that you use your time wisely and efficiently per section, because each section has equal weight for the grade, even though one section you might want to talk about other materials. The other part of the grade that's going to be very important is that for the PowerPoint, you're summarizing. You're summarizing the key elements. The paper, you can write it all out, right? But the PowerPoint, you're going to summarize. So today in class, we're going to cover the key things that I want in there that I need you to summarize. And again, I'll give specific recommendations to the exhibits that you have to have in there. But the other point is this is a finance class, which means anything that you're summarizing has to be based on data, right? You can't just make an assertion and not have data to back it up. So you have to show the data, and you have to refer to data points in your presentation. If you don't refer to the numbers, you're going to have your grade reduced as being too vague. Okay? So you got to be specific. Now, it doesn't mean I want you to overly read every number. You got to strike a balance, but you got to refer to numbers in your presentation. So even on a screen like this, I can't just say the industry ROIC has been improving. I should say the industry ROIC went from about 8% to 14%. Okay? So I should give a reference to a number, not necessarily reading every number that's on the screen. But notice the difference in those two statements. Remember that when you're writing your paper. Remember that when you're doing your PowerPoint. Okay? All right, 4 sections. Section number 1, EIC. Right? what needs to be included in the EIC, right? This is the overall understanding of the E is the economic sensitivity, so we will start there. So I'm going to give you some choices today. But the first thing you have to do, and again, I'll use Walgreens as an example, is I need a beta. And specifically, I need a 5-year equity beta. So here's Walgreens 5-year equity beta, 0.718. We are using the raw beta in this class. So the whole point of the E is I should say that Walgreens is not as economically sensitive as many other companies, right? So they're a little bit more, a little bit less sensitive than the average company with a beta of 7.18. So I'm less concerned about what happens to the economy when I evaluate a company like Walgreens. That's really what I care about in the E section of the EIC. And you need to have the beta to back that up. Now, I'm going to give you an alternative, which I would also consider to be better. If you go to the RV section of Bloomberg, you go to Custom. Under Columns, you type in beta, and you'll also notice that you can use the raw beta across multiple companies. So I can also do on a customized period by exact date up until November 10th, 2014 versus November 10th, 2009. Here is the beta for all 3 companies, market cap weighted average. So here's the point. The industry beta is 0.81 and Walgreens beta is 0.76. So not only is Walgreens not economically sensitive, but this industry is not economically sensitive to changes. Subtle difference, but to me this is actually an even more powerful part of the E, and something that I think will be more relevant, particularly when we have the 20 minutes to talking to the corporations that we're going to be talking to. All right. Second part of this, by the way, is that if I were doing Rite Aid, then what I would say is Rite Aid is in an industry that's not very economically sensitive, but Rite Aid happens to be very economically sensitive. So they're actually different than their peers. Again, an important distinction to make. For purposes of your paper, you can choose either one, because the original requirement was just doing a 5-year equity beta for your company. However, doing the industry one gives a little bit more context. This is how you can do it. So it's either or. You do both if you want. Okay? So you need a screenshot of your betas. Second, the I section, the industry section, which means I need to go to the RV and we had earlier calculated a spread. Now here's the challenge with the RV, which is Walgreens has an NA. For some reason, Bloomberg is having trouble calculating an ROIC. So this is not acceptable. We can't have an NA, particularly the company that we're presenting, in this screen. So we have 2 choices. Number 1, if I want to use the RV screen in Bloomberg, I would have to manually calculate the ROIC for Walgreens, export this to Excel, and then recalculate this screen using the Bloomberg methodology. Okay? So the Bloomberg methodology is the NOPLAT divided by debt and equity. So I'd have to figure out the debt and equity. I'd have to manually calculate the return of the debt and equity, and I would have to then recalculate an industry spread. That's the way I'd have to do the RV screen. Or we just did a super tree, and in a super tree, we just calculated ROIC for the industry and their peers. Use the super tree industry ROIC. Now, if I have a preference, I will now state that I prefer the super tree over the Bloomberg ROIC. Why? Because the super tree ROIC is the ROIC from our model. The ROIC from our model is an operating ROIC. The operating ROIC is different than the Bloomberg ROIC because the Bloomberg ROIC includes non-operating assets. So this is the return on all of the assets where our model is just the return on the operating part of the assets, the invested capital. So to be honest with you, it's probably more consistent with everything we're doing in our valuation to use the industry ROIC from the super tree than the industry ROIC, which was simple, from Bloomberg, because that doesn't really coincide with the operating performance we've been talking about all semester, right? That's kind of a subtle change at the last minute, but nonetheless, if you originally planned to use this screen and you got all the data, you can use it. But I'm saying, given the choice, this is probably better data. And if you're missing data on your tree, on your ROIC, then you're going to have to do it anyways. And here's the worst possible scenario. What's the problem if I use this screen with replacing Walgreens NA with 11.6%? Would there be a problem with taking 11.6% calculated from the model and just sticking it on this slide and then using that number? What's the problem with that?
Those include non-operating.
That's right, it's an apple and an orange. I now have an operating ROIC matched against non-operating ROICs. That includes the non-operating stuff. So I'm not doing an exact comparison. So that's what I'm saying. It's also very important to have consistency in your data. All right, and so don't just create inconsistent data. So if you have to manually create something, manually create it in a way that's consistent with the other data on the page. So that's what I'm saying. If you wanted to use the Bloomberg data, you have to calculate it the way Bloomberg calculates it. You can't use our model calculation and stick it with the other Bloomberg calculations. Right? If you do it the way the model calculates it, then you got to put every other company the way the model calculates it. That's the one advantage of doing this exercise for your company, because you all have it in a consistent way. All right, so that's the first part of the I. You need the industry spread. You need an industry WACC, so you can use the same WACC for either one, but then you need an industry ROIC spread. Okay? Then you need a five forces explanation. Right? So you need a table. So in your papers, you're going to write up all the forces, just like you did in your homework assignment and the changes. And you got lots of space to write in the paper. In 2.5 minutes, you're not going to be able to go through every force. If you have a person that gets up here and presents and tries to explain every force and every change in force, they're going to take 7 of your 10 minutes just doing that, right? And that's not going to work. So this is what I recommend for your presentation on Monday. Put a table in the PowerPoint. And what a team mentioned this morning, and we can borrow from their suggestion, was low, medium, high. So just list low, medium, high for all the forces and the overall current change in 5 years. So, and then here's the other point. Don't go through the all 5 forces explanation. Talk about the ones that are most relevant. Okay? Then for the C, talk about competitive advantage. In the ROIC, do they have competitive advantage, and how does that change over time? Okay? So, to give you an example of this, I'm going to do approximately 2.5 minutes as if I were presenting Walgreens right now to you. Okay? Just kind of in, now I don't have all the slides because I went through a couple of screens. So let me go back here to the custom. I should have saved this template with the betas. Let's go back to my beta here. Customize by date. So I want yesterday and 5 years ago yesterday. Okay. So this is my presentation for EIC. All right, so Joe covering Walgreens. I'd like to talk to you about the EIC. So starting out with the retail pharmaceutical industry, which you can clearly see is the overall beta for the retail pharmaceutical industry is 0.81 and Walgreens is 0.76, suggesting that both the industry and the company are not very sensitive to changes in the economic conditions. Right? So I'm going to be less concerned about changes in the economy. Relative to the I, the industry performance, this industry's ROIC is about 13.5%. This industry's cost of capital was about 8%. It's achieving a positive spread and is an attractive industry. Over the last 5 years, the ROIC for this industry has actually improved. However, most of the improvement has come because of Rite Aid's improvement in ROIC. And what I really see is that the industry's ROIC, when you take out Rite Aid's improvement, hasn't really changed that much. I think when I think about the Michael Porter's 5 forces, the primary reason why this industry has a positive spread is, number one, the buyers do not have a lot of power. Because there's 3 primary retail pharmacies that you get your prescriptions from, and you got lots of customers out there, and there's not a lot of competition, there's not a lot of choice, and therefore there hasn't been a lot of pricing pressure. I also think that substitutes have not been a strong force to this industry because people aren't getting their prescriptions by mail, and they don't have a lot of other choices to get it. And historically, they've all been getting similar prices from the payers. I think over the next 5 years, that's going to change. I think there's going to be more options for people to get their pharmaceuticals, which is going to allow prices to start to come down. I think substitutes, as we get used to services like Amazon and getting things to the mail, are going to become more pervasive. And I think through the Affordable Care Act, the government is going to start putting pressure through lower reimbursement rates and higher copays on people, which is going to cause the pharmacies to get lower margins, and that is going to hurt the overall profitability of this industry, which drives most of their revenues from the pharmacies. So I actually think that the industry is going to get tougher over time. And from a competitive advantage, I do not see Walgreens currently having competitive advantage because they earn an 11.6% return in an industry that's making more than 11.6. They have a relative lower return than the industry average. And I also think that this is not going to improve dramatically in the future because though Walgreens is trying to get more into the retail space, unfortunately, I think the decline of profitability in their pharmacy is not going to be made up by the improvements in their retail space, and so therefore I don't see a dramatic change in their competitive position going forward. I don't know how long that took, if anybody timed me. Probably a little bit longer than 3 minutes. I need to be tighter, but that's the level of detail I'm expecting on Monday. That's the EIC section in your PowerPoint. I would come prepared with note cards, right? I would come prepared with the exhibits. Notice I didn't go through every number. Notice I didn't go through every force. I would have liked to have the table of forces behind me so I could see the reference. If a question comes up, I should be prepared to answer it, but this is going to have to be your level and cadence because 10 minutes goes by very fast. Now, when you do the corporate presentation, you're going to have 20 minutes. That's going to feel like a lot more time after preparing for 10, and that's when you can go into more detail on these things. But I just want to make sure that on Monday we're getting the highlights and that there's no fundamental flaws in our logic. That's what I'm really going to be grading you for on Monday. So that's why you're just going to be tight in your presentations, and these are the things I'm looking for. That is the EIC section. Questions about any of that? Okay. Section 2. Section 2 is the historical performance. There's 2 parts to the historical performance. One is the ROIC tree. So again, you have 2 choices here. Choice number 1, you can go back to any of our models and you can go to the ROIC tree, the ROIC drivers, and basically you could just go through this, just like we've done on many assignments, including the midterm exam. So that's option 1, right? What I'd like you to try and do, though, is option 2, which is to use the super tree. Because I think this is going to be more interesting for both you and more interesting for our corporate speakers that are going to be coming in a few weeks. Because this will not only give us the context of our company, but also the context of how our industry is changing over time. Okay? So, assuming we were doing the super tree, like I said, remember there's 3 major things that are going to change about the ROIC. Tax rate, margin, productivity. How do those 3 things affect the change in ROIC over time? That's the heart of what you're trying to answer. Right? You're either going to answer it for your individual company, so my company is getting better, worse, or staying the same because these 3 factors are determining it, and this is what's happening, these 3 factors that determine it. Or my company and the industry are changing, and here's what's changing differently. So again, approximately a minute and a half. Right? So let me go through this in a minute and a half. So I'll start with again, a Walgreens perspective. Now I'd like to move on and talk about the ROIC tree for Walgreens and the historical performance. So what we can clearly see is Walgreens' historical ROIC went from 12.6 to 11.6. It went down slightly. Interestingly, the industry's performance actually went up from about 7.6 to 13.5 during that period of time. Most of the industry performance was due to Rite Aid catching up with Walgreens and CVS, where Walgreens actually saw pretty steady performance, which slightly declined. If we think about it, what was behind it? First, tax rate. Walgreens actually paid slightly higher taxes, so that hurt them a little bit, but ultimately that didn't affect their pre-tax ROIC as much as the decline in the operating margins going from 5.1 to 4.7. So Walgreens actually saw a decline in their margins, which was somewhat benefited by the improvement in productivity as invested capital sales went from 25 to 23. At an industry level, the overall industry improved for Rite Aid because primarily the fact that they went from losing money to making money, their operating ROIC went from 0.7 to 17.8. That really helped the industry ROIC pre-tax go from 12 to 18 because they went from 0 to 3% operating margin, which was the primary driver at the industry level. You're shaking your head? Something confusing?
No, it's not confusing. It's making your own math.
Yeah, as I said, you really need to practice, and I would strongly recommend having some note cards to help you with all of this, and be scripted. There's nothing wrong with being scripted for this presentation, but I also would, as I said, practice, because if you come in here and you're unpracticed, 10 minutes goes by really fast, and you could really have some challenges with your grades if you kind of drag on. And what I'm trying to illustrate by giving you examples here today is that I'm not expecting in 10 minutes for you to cover everything. So what you really have to do is prioritize. And you got to prioritize what the most important, WIFMs, what's in it for me, what's the real important things that I want to focus on that I think are relevant to really understanding what's going on here. And so that's really the challenge, is how do I figure out those elements. That's what's in your PowerPoint. You have more time to give detail in the write-up. So the write-up is going to be far more detailed and cover a lot more things. The PowerPoint is the summary, and that's where you're just focusing on the key items. So can you figure out what really matters here is what I'm going to be looking for when I'm listening to the presentation, as opposed to just give me a data dump. You got to tell me why. Okay? Here's the other half of the historical analysis. So you need the ROIC tree. Second screenshot you're going to need is the CFI. Again, if I go back to the concept of the super tree, industry level super tree, to some degree, these are the four things that I think are important to talk about the industry. This is what's going to be really interesting to the corporate speakers. So I think we should start to practice including it in our papers and even PowerPoint. And I can even keep it at a simple level. So as I said, at the four things level, what are you really saying? Our gross cash flow was about $60 billion. Free cash flow was $40 billion. Reinvestment rate was 27%, which means that the payout rate was about 73%. And specifically, that was a theoretical payout rate. What was actually paid out was $29 billion of the $40 billion of free cash flow was paid out. And you'll notice that Rite Aid really didn't pay it out. All that payout was happening at Walgreens and CVS. So that's really what you need to say at the historical level, right? If you include the super tree part, just kind of hitting at the highlights. Then when you do your CFI, you then also, and this is what is required regardless, is for your company to actually go to the CFI tab and to go through the CFI. Again, you're not going to have time in the PowerPoint to go through all 5 years in all the detail and all the sections. In the paper, yes, you should cover the 5 historical years, and you should cover all 4 sections. But in the PowerPoint, you're going to have about a minute. So when you do your presentation. So what really matters? Similar to what I showed you on the super tree part of the CFI. which is for Walgreens, $17 billion worth of gross cash flow, $6 billion worth of reinvestment, 37% reinvestment rate, leaving them with about $10 billion worth of free cash flow. They spent $7 billion on non-operating cash. Don't know why, should have an explanation for that, leaving them with $3 billion to pay out to investors. They borrowed $2 billion, they paid $4 billion of dividends, $6 billion of share repurchase. The $10 billion that went to the shareholders was approximately the $10 billion of free cash flow they generate. That's what you're going to have time for in the PowerPoint. All right. In the paper, you should be talking about the historical years. You should be talking about the consistency of their gross cash flow over time. It's been the low $3 billions. You could talk about the reinvestment rate, which the CapEx has really been pretty consistent. The one thing that's changed has been the working capital, other things we've done in previous assignments. But I'm telling you, if you get into that level of detail in a 10-minute presentation, you're just going to run out of time. So as I said, focus on the things that are most important to convey to a user that's trying to understand the company itself and the company's valuation. So are they generating cash? Are they spending cash? And are they paying out cash? Those are the things that the investors are ultimately going to care about. So, that's the point. It's important to understand that Rite Aid is putting 10% reinvestment when the rest of the industry is putting 30% reinvestment. That's interesting, because that tells me a different story about their model. It's important to understand that Walgreens and CVS are paying billions of dollars out in dividends and share buybacks, and Walgreens and so Rite Aid is paying zero, right? That tells me something about those companies and about how their performance is going to be over time. So it's really just kind of hitting the highlights that are going to matter to this historical section, because it's this historical section that then sets up what we're going to forecast with evaluation. Not that the past predicts the future, but the understanding of the past will help us as we help our understanding of the future. And one of the nuances that I wanted you to get out of this exercise with the super tree that I started earlier is that on the surface, it looks like this industry is getting a lot better. And I don't think that the industry is getting a lot better. I think the industry has been a constant, decent performer. And I think that it's going to stay a relatively constant, decent performer. I don't think it's going to get a lot better in the future. That the lot better has been the poor performer improving, not because the whole industry is such a more attractive industry. And I think that's going to carry over to my point of view on the next 5 years. It may be a different point of view that you have, but that will influence what I talk about in the multiples. That will influence what I talk about in my valuation. Okay, section number 3, multiples. Again, I don't know what happened to it, but I can't find my Walgreens multiple file on my laptop today. I guess I just did not bring it to class. So for purposes of talking about this section, I'm just going to go back and refer to the Walmart data. Okay, so here's the point about the multiples. You're going to have to give me a screenshot in the PowerPoint and in your paper as an exhibit that looks a lot like this file. So you got to show me the table of the multiples. You can hide the market cap. And you got to give me the margin G's and the spreads. Right, just we did with the Chipotle McDonald's exercise last week. All right. So here's the idea. This data that I have highlighted explains these multiples. Right? And I can't tell you that, as I said, when the corporate speakers are here, what they're going to care about are going to be 2 slides that you're going to put up. Slide number 1 is that industry CFI. They're going to really perk up and pay attention to that, just based on my experience dealing with corporations and banks. And the other one is this, because companies and banks often try and figure out, why am I trading at 11 times earnings when my competitor's trading at 13 times earnings? Why shouldn't I be trading at those 13 times earnings? So they're always looking for an answer to that question. And the bankers are trying to look for an explanation to explain to the companies an answer to that question. With this slide, you have the ability to deliver an answer to that question. And that's the point. These multiples are based on these components. And that's what you're focusing on. So here's the idea. And this is what's going to be different about the paper versus the PowerPoint. The PowerPoint, you got, again, 2.5 minutes. You're not going to be able to talk about all 6 companies. Right? But the general premise is this. Premiums or discounts. Right? Premiums mean multiples higher than everybody else. Discounts means multiples lower than everybody else. Why is it a premium or discount? Those factors, margin growth and spread, should explain whether it's a premium or discount. So, what I should be able to say, Walmart is trading at a discount to its retail peers. And again, I don't have to explain why I chose those peers. The people I'm talking to in this presentation, including me, know about the retail industry and know about how these multiples are created. So you don't have to explain to me the formulas you used or even why you selected your peers. If I want to ask about why you selected your peers, I'll ask it to you. I'll assume otherwise you figured out that those are the appropriate peers. So back to this. So for this peer group, if I look at Walmart, Walmart is trading at a little discount to the industry average multiples, particularly on EV to EBIT, EV to EBITDA, and PE, because they have the lowest growth rate in the industry at about an average level of spread. Right? So really, Walmart is trading at a discount because they're not expected to grow long term. That's why Walmart is trading at a discount. And that's insightful. Right? Matter of fact, let's go. The difference. Why is Family Dollar, when we're talking about this exercise, trading at a premium to Walmart? Well, the thing is that Family Dollar is also not expected to grow, but Family Dollar, through a quirk right now, has a very low cost of capital. Probably because they're over leveraged in a low interest rate environment. And that extra spread is giving them the premium. So Family Dollar is not trading at a premium because they're a better company growing faster. Family Dollar is growing a little bit, has a better premium because they're growing about the same rate, and they just so happen to right now have a lower cost of capital. I'm not sure that that's sustainable over a long run, so I'm more concerned about Family Dollar's premium multiple than I am about Walmart's on a go-forward basis, because if Family Dollar loses that cost of capital advantage, which could easily be lost to the bigger companies, then their multiple is probably going to come down. All right? Now, here's the thing. Who's really doing well in this industry? And it appears to be Dollar Tree. And the reason Dollar Tree is trading at a little bit higher multiple than the average, particularly for EV to EBITDA against the market cap weighted average and PE against the market cap weighted average, is because they have a little bit higher growth at a little bit better spread. So again, I don't expect that you go over all the companies. What I expect is you pick 2 or 3, your company being one of them, and explain why you think that they're higher or lower and talk about it on a difference level. Now, one of the trucking companies earlier came up to me and they said, well, we have 4 trucking companies in a rail. And I said, well, put the rail as a proxy and then put the trucking companies as a proxy. And you can talk about the trucking company peers versus the rail peer as groups, and because all the multiples for the trucking companies were very similar. So talk about why they're all similar. Similar growth, similar return, similar cost of capital, similar multiples. You don't necessarily have to go through every single nuance, right? As I said, in the PowerPoint. In the paper, yes, I do want you to talk about all 6 companies. In a sense, I do want you to rank them. Why is one higher than the other? And give a full explanation. But in the PowerPoint, you just won't have time. You got 2.5 minutes. Again, questions about this section. Question about what's required. Section 4. Final section. The valuation. The valuation and your buy, sell, hold opinion based on the target price. Again, you're only turning in your final valuation Excel file. You're not turning your as is. Right? However, in your as is valuation, let me open up Walgreens. In your as is valuation, we put in, and this is key, based on the multiples. So you should have done, or if you're about to do, you should do the multiples and the as is on the same day. Okay? Because remember, the multiples are helping you with the as is. They're explaining the price. Don't separate those out into 2 different weeks, because otherwise you'll start getting discrepancies between the 2 sections. Right? So that's the point. The multiples give us a G that we're going to use in our assumptions. So this is the G that I used in Y. This is the margin, EBITDA margin I used in Y. This is the revenue growth rate that I used in Y, and this is the tax rate I used in Y to get the as is. So you're not giving me the model, you're just giving me those 4 assumptions that you really put in that explained the current stock price. That's a slide detailing those assumptions. For the final valuation, for those 4 assumptions, did you change any of those that led to a different stock price? Why did you change them? Right? Because remember, for the as is, we're just trying to explain the current stock price. It's not whether we agree with the stock price, it's what explains the stock price. And then we put in our opinion, which could be a different growth rate than the market is using. We could put in a different margin than the market is using. Could put in a different tax rate than the market is using, and why. And the why could include things like, go back to Novellus. The automobile industry, which right now is 9% of Novellus' revenue, is about to explode in growth, and that's going to cause the increase in margins in the future, which is going to lead to higher growth rates and higher EBITDA margin, which is why I made these changes in my model. Okay, so link it that way to your change in assumptions. That's why my final could look different than my as is. Okay, and I'm modeling that out, and that's why I put in these assumptions, and that gave me the new price. The difference between those two prices is because you'll call that your target price, your final, is going to do the buy, sell, hold. Okay, again, plus or minus 10%, you're in a hold range. So maybe your answer is, I don't see any difference in the price. I don't see any difference in the assumptions. I'm comfortable with what the market's using, and therefore it's a hold. Or maybe I think it's a sell. I think the market's over optimistic. Or maybe I think it's a buy. What is that delta? What is your opinion? Okay, and then buy, and use the words buy, sell, hold in your presentation. That's the 2.5 minutes. And here's the one thing that's new. And again, I apologize for being in the hospital on Monday. We didn't get to cover this on Monday, and it's the end of class today. But this is probably one of the more important slides that you have to put in your presentation. It was mentioned in the detailed write-up when I gave you a list of all the requirements last week, and I got a couple questions about it. I want to cover it right now. It's the ROIC chart. Okay. Your final PowerPoint slide and the exhibit that's at the end of your valuation of the company is going to be called the ROIC chart. So here's what I want you to do. I want you to go to the EPEOY tab, which is the end of year economic profit, where we estimate ROIC, again, after goodwill. This is the historical ROIC and the forecasted ROIC of the company. I want you to take all 16 of these years, the 5 historical years and the 11 forecasted years, and I want you to turn it into a line chart. So that's a line chart of the historical and the forecasted ROIC, in this case for Walgreens. Right? And on my line chart, 16 periods, I can right-click, select the data. For the x-axis labels, I can actually label this so I know which year is which, from 2010 to 2025. So there's my line chart of the ROIC for Walgreens. Again, historical, future valuation. Right? Now, a long, long time ago, a land far, far away, beginning of the semester, back in September, there was a lecture that I know a lot of people didn't pay attention to, based on earlier classes today. I'm going to see if I can find it. Early lecture notes. I think it was in lecture 1 or 2. Let me go back and look. It was in lecture 2. Oh, here it is. In lecture 2, we were going through lecture 2, and I said that this was a really important slide. And remember this slide, because later we will be using this slide. So this is your remember this slide. And what this was a slide that McKinsey showed us, was they said they looked at publicly traded companies' ROICs over time. And they did a buy and hold strategy based on quintiles of ROIC performance historically. And what you saw is no matter what quintile you were in for ROIC, there was compression towards the mean or towards the cost of capital over time. And it kind of makes intuitive sense. It says that no matter how well you're doing now, you're probably not going to be doing well 15 years later. That's Econ 101. Markets mature. Competitors catch on. They benchmark you. They copy you. They follow on what you do. The customer evolves. Or, same thing, underperformance becomes very Darwinian. Look at Rite Aid. Investors start starving them of capital, and it forces them to either improve their performance or they're going to go away, so they find ways to improve their performance. So even when you're poor performers, you tend to start moving up over time. That should be our bias. So particularly when we're valuing companies into perpetuity, we don't expect in the out years that we get what are called hockey sticks. Hockey sticks are performance that continues to go up and up and up into the future. That usually doesn't happen. Okay? That should be our bias. So here's the point. You are creating a valuation model, which is forecasting essentially ROIC. So I'm asking you to graph your forecast, and this is what I'm going to call the sanity check. This is your sanity check against your final valuation. So when you give me your final valuation, you have to put up this chart, and it's got to pass the laugh test. And if I start looking at that chart and I start laughing, then you can assume that your grade is going down. Okay? Because I'm not believing your valuation. Because this is another way of saying, does this make sense? So what I already noticed about Walgreens, because we just did an industry ROIC, we just did the Super Tree ROIC, is that this has been the historical performance of the industry. The industry was getting better because Rite Aid was catching up to Walgreens, not because Walgreens was doing substantially better or CVS was doing substantially better. Yet to justify the current stock price at the time, this was the as is, their ROIC, which had been in the mid-teens, has to be in the upper teens consistently forever in order to justify the current stock price, which means that in a way, built into the current stock price is improvement. Built in is the idea that they're going to get some benefit from this beauty, change in their business. Now, how much of a benefit? To be determined. But here's the point. I then do my final valuation, and I start drinking my own Kool-Aid. So I come back to Walgreens and I say, okay, I think that Walgreens is going to grow at 4% a year, because they're in this health and beauty market. And I think that their margins are going to start looking more like Boots margins. So it's going to get to 8%, and then 8.5%, and then 8.5%, and then 9%. And that's going to be an $87 target stock price. And I'm in the strong buy category because this isn't even the margins that Boots was earning last year. And now's the time to jump in. All seems reasonable, and then I go to my ROIC chart. Does that seem as reasonable? Because in order to get to an $87 stock price, their ROICs have to be in the low 20s. And they're in an industry that hasn't come anywhere near the low 20s. It's been in the low teens. And what's going to dramatically change about this business to say that it's going to go into the low 20s? And again, think about the EIC. I either have to have so much of a better industry, and in my 5 forces, I'm not saying this industry is getting all that much better, or I have to have so much more competitive advantage. And to be honest with you, with the photographs that we saw, I didn't see anybody in any of my 4 sections of 160 undergrads that were like, oh, I can't wait to go to the next Walgreens. You weren't just stampeding out to their 8,000 stores because just putting a few high-end products in their existing stores didn't seem like the compelling message that was really going to change people's behavior to then suddenly see the big jump to buying their products. And that would be the other thing. We didn't even get into competitive, but somebody, I think it was even in this class, that said, I love CVS. And I think CVS is probably a better company for this stuff in their image than Walgreens. You don't think CVS, if Walgreens is successful, isn't going to start doing the same thing, and that's not going to put pressure on the other companies to compete with them. So that's what I'm saying. Are they really going to get some advantage that seeds everybody else? I'm not saying they're not going to improve, but look how much improvement they would have to get in order to justify that strong buy at $87. So what I'm telling you is that based on this chart, which one do I think is more believable to the long-term story? My personal bias is the hold. My personal bias, which improves to 16% versus 21% on a sustained basis, is this is a hockey stick. This is that improvement in the out years that is often difficult for companies to sustain. And this is not the current period. This is the future periods getting better and better. And this doesn't look like that. Now, can hockey sticks exist in the real world? Absolutely. As a matter of fact, there's one company out there that I can name today that has an absolute hockey stick, which is even steeper than this. It's an incredible hockey stick, where the performance in the past looks nothing like their performance in the future, and their future is as bright as it possibly can be. Who am I talking about? Apple. How many companies with $30 billion of revenue in 6 years go to $180 billion of revenue and have the types of returns that they do? And the answer is one in the entire history of the world. So can it happen? Yes. Do we have lightning in a bottle here at Walgreens? Probably not. So I'm not saying you can't see it happen, but you got to be talking to me about disruption and reinvention and all this other stuff in the rest of your presentation to convince me that this is the next Apple. And I'm not saying that this chart is an Apple-like chart, but that's the point. Where is this run-up in performance really coming from? You got to justify it. And if you can justify it, you can justify the chart. But that's what I want you to then do as your sanity check. So this becomes your final slide, and this is what you tell me after you give me the buy, sell, hold. This is why you're comfortable with your buy, sell, hold opinion. Just be able to explain this chart. That's all I'm looking for. And it doesn't have to slope down, but if it's not sloping down, why isn't it sloping down? That you can reasonably explain. Questions about any of this? Does it make sense? I'm asking you to. Yes?
If you get a question in the middle of the presentation, does that count towards minutes?
It would, but most likely I'm not going to ask you questions during the middle of your presentation just because you don't have time. So here's what's practically going to happen. I'm going to try, if I do have a question, consider that bad for your group. Okay? Because what I'm going to do is I'm going to be confused. I'm going to try and have you clarify something. So the real idea is you don't want me confused. You don't want me asking you questions during the 10 minutes. Now, you're going to have 20 minutes when somebody from the outside shows up. And that's when I would expect some questions to come up. Right? Because they're not just going to sit there for 2 hours and listen to a bunch of presentations and just say, I've wasted my time. They're going to probably have curious questions about your analysis. That's where the extra 10 minutes will probably come in. However, here's the other point, which is I'm trying to gauge, any feedback that I can give you to get you to that 20-minute presentation and improve upon it. So I want to kind of hear from you as opposed to hearing from me. So I'm probably not going to ask a lot of questions on Monday. Just a sense of that. And then we have a week to improve on things before we then turn it around to the final papers and the corporate presentations and to some degree resubmit for final grades. So it's also your chance that if things aren't perfect to improve upon them. So it's not a one-time grade. Remember, half the grade is Monday. The other half of the grade is when you finally submit and represent. So it's really a draft. You're getting a draft graded. Yes?
What's the mean grade you usually see on this? Is there?
I don't know, and I say that because this is a new format that I haven't done in the past 6 years. Right? In the past 6 years, I've never did this interim step. So the mean grade was always based on a one-time submission. So we've never done, and they always did 20 minutes. I've never done 10-minute presentations before. So I don't know. I will tell you that, out of 20 points in the past, usually teams average between 16 and 17. But that was one time after they spent everything and had 20 minutes plus wrote all the papers, right? And so I don't know where we're going to end up. But, as I said, I'm giving you lots of prep, and all of this has been recorded, so you have some practice. And I even did my own little practice on Walgreens, which I'm not saying you should follow exactly, but it's kind of representative of the types of things that you guys should do. And as I said, the other thing I've done in the past that I'm not doing here is in the past I made every team member present. So if you had 7 people on your team, 7 people had to talk during the 20 minutes. For the 10-minute presentation, you could have one person do all 10 minutes. Right? And I don't recommend 7 people doing 10 minutes. It just, you won't finish. Just the moving between people, the cadence of that will get screwed up. So as I said, it's really, and what's primarily different here is that in the past they've never presented to real companies. So this is just to make sure that not only do we understand it, but that our presentations to the real companies actually make sense. So that if there's any real challenges in our logic, we have a week to address it rather than going in cold. That's really the main reason why we're doing this. So again, logistically, Monday you will, and this is recorded on YouTube, so Monday you will do your presentation, turn in your papers, you'll get your feedback right at the end of the class, and then by that following Monday after Thanksgiving, you'll get the graded papers back and then have a week to then readjust that week after Thanksgiving. There will be no homework assignments between Monday and the following Monday. Okay? So remember, the Wednesday before Thanksgiving, but basically the Wednesday before Thanksgiving is that individual group project time that we had talked about that you will have time to do that is non-graded in the lab because we're not going to have a physical class, so you have time to work on that individual project in the lab. And then the following Monday we'll come back, we'll get the feedback, and then we'll do some stuff for the grade that following week. But there will be no graded homework assignment that will be due between Monday and the time you get back for the Thanksgiving break. Okay, questions? Any of that? Make sense? All right, we'll see everybody on Monday, ready to go with their presentations. Have a good weekend.